Big news for anyone on benefits or the state pension from April 2026. Payments are increasing, and for many, it could mean hundreds more in your pocket each year. But not everyone will benefit equally, and some changes could even reduce certain payments. Stay with me, because in the next few minutes, I'll break down exactly how much you'll get, who's affected, and what you need to know to make the most of these changes. Let's start with the state pension, which is set to increase by around 4.8%. For those on the new state pension, weekly payments will rise from roughly £230 to about £241. Over the course of a year, that adds up to over £12,500, providing retirees with additional breathing room for everyday expenses like groceries, energy bills, and other essentials. Those on the basic state pension will also see their weekly payments increase from around £176 to nearly £185. This increase comes from the government's triple lock system, which ensures that pensions rise in line with inflation, earnings, or a minimum floor, whichever is highest. For pensioners, this uplift helps maintain purchasing power and can make a noticeable difference in day-to-day life, especially as living costs continue to rise. Moving on to universal credit, standard allowances are being increased by about 6.2%. For a single person aged 25 or over, monthly payments will rise from roughly £400 to around £425. Younger claimants under 25 will see their allowance increase from about £317 to roughly £339 per month. Couples will also benefit. For a couple where at least one partner is over 25, the monthly payment rises from £628 to around £667, while couples under 25 will see payments increase from £498 to about £528. These increases provide extra financial breathing space, helping households cover rent, utilities, and everyday living costs. For people receiving disability support through PIP, payments are also being increased in line with inflation. The daily living component will rise from around £74 to roughly £77 for the standard rate, and from £110 to about £115 for the enhanced rate. The mobility component will increase from £29 to £30 for the standard rate, and from £77 to approximately £80 for the enhanced rate. For many recipients, these increases help offset the rising costs of care, mobility aids, and other disability-related expenses, ensuring that support keeps pace with inflation. While these increases are positive, there are also important changes to consider. Some elements of universal credit, particularly the health-related or limited capability for work components, are being reduced or frozen. For new claimants from April 2026, the health element will be cut by roughly half. Existing claimants will see this element frozen until at least 2029 or 2030. This means that households relying heavily on these additional payments may feel a decrease in total support, even as standard allowances rise. It's important for anyone affected to review their benefits and understand how these adjustments will impact their finances. All of these changes take effect from April 6, 2026, at the start of the new tax year. That means your next payment after this date should reflect the new rates. Timing may vary slightly depending on your individual payment schedule, but generally, these increases will be applied automatically. Being aware of these changes allows you to plan ahead, budget more effectively, and ensure you are claiming the full support you are entitled to. For retirees, the state pension increase is particularly meaningful. It provides extra financial stability and a buffer against rising costs. Even a modest increase can make a difference in paying for energy bills, groceries, and day-to-day essentials. For working-age adults and families on universal credit, the increase in standard allowances means more flexibility to manage rent, bills, and household expenses. For disabled individuals receiving PIP, the inflation-linked increase maintains the value of the benefit, ensuring that essential care and mobility support remain accessible. However, while these increases are welcome, they do not fully offset all pressures. Rising energy costs, housing expenses, and everyday living costs continue to strain household budgets. It's therefore essential to not only be aware of the increases, but also to plan accordingly. Understanding which elements of your benefits are changing and how they interact with your overall financial situation is key to maximizing the support available. This April 2026 increase is part of a broader government strategy to respond to the ongoing cost of living pressures. While it may not completely cover every expense, the additional funds provide meaningful support for those most in need. Pensioners can enjoy a modest increase in retirement income. Working-age adults on universal credit can manage day-to-day expenses more easily, and disabled individuals can maintain vital support for daily living and mobility. It's also worth noting that some households may see the impact of benefit freezes or reductions. Families relying on the health-related elements of universal credit, or those with multiple complex needs, should review their entitlements carefully. Consulting official government guidance or using online benefit calculators can help ensure that you understand exactly how your payments will change and whether any adjustments need to be made. For anyone receiving PIP universal credit or the state pension, staying informed is the first step. Review your letters from the Department for Work and Pensions, check your payment amounts, and make sure you are receiving the correct rates from April 2026 onward. For those supporting friends or family members who rely on benefits, this knowledge can help plan household budgets, manage expenses, and avoid any surprises when payments increase. These changes also highlight the importance of being proactive about benefits. Even small increases can make a difference in budgeting and household planning. For retirees, it might allow for a little more comfort or savings for emergencies. For working-age adults on universal credit, it can provide flexibility in managing bills and household needs. For disabled individuals on PIP, it ensures that the support continues to meet rising costs associated with health and mobility. It's clear that April 2026 brings a mix of good news and challenges. On one hand, standard allowances and state pension payments are rising, offering tangible support. On the other hand, certain elements of universal credit are being reduced or frozen, meaning that some households may need to adjust to changes in their total income. Awareness and planning are key to navigating these changes successfully. As these increases are implemented, it's important to double-check your entitlements. The government usually applies the changes automatically, but verifying your payment details ensures you are receiving the correct amounts. Keeping track of official letters, notifications, and statements can prevent errors and ensure that no payment is missed.